welcome back to EDU-Tutor. Today we want to look at insurance and the difference between insurance and assurance. Now remember that insurance, in order for you to get an insurance, you will need to sign a contract. So this is related to contracts, the topic of contracts. Now an insurance can be defined as a legal contract in which an insurer promises to pay a specified amount to another party, which is the insured, if a particular event happens and the insured suffers a financial loss as a result. So, in this definition, we can identify two aspects that we will need to define. The first being the insurer, and the second being the insured. So the insurer would be the bank or the insurance company, while the insured would be the party who will receive the money if they suffer any financial loss. Now, insurance is a means of protection from financial loss. Insurance is generic for all types of insurance and assurance. However, insurance is different from assurance. How? Insurance covers risks that may occur. So you might have a fire, you might get into an accident, someone might burglarize your property. However, it's not a must, right? Assurance, on the other hand, covers events that have to happen. And to be specific, assurance covers death because it must occur. So therefore, the life insurance is actually assurance. The parties to the insurance contract are the insurer, which we said that is the company that is offering protection, and the insured, who is the person seeking protection. Payments are made by the insured for this service, and they make it in premium, so a monthly premium, and the contract which they sign is known as a policy. What are some principles of insurance? So the purpose of insurance itself is to compensate persons insured who suffer loss. It is based on the principle of indemnity. Now, the principle of indemnity says that the insured must be restored to its original position before he suffered loss. Let me repeat. The principle of indemnity says that the insured must be restored to its original position before he suffered a loss. Insurance, therefore, does not make a person better off or worse off. For example, if Mr. Green suffered damages valuing $500,000 subsequent to a fire at his home, he will only be compensated $500,000 to repair his house. So he will not receive more money than the $500,000. If anything, he will receive less if he cannot prove that that is the amount of damages that he lost. All right. We also have some more principles of insurance. We just spoke about indemnity, where we said that the insured will be restored to its original position before the loss. The second one is insurable interest. So the insured must have a vested interest in what is being insured. So you cannot insure somebody else's house because you don't have an interest in that particular item. The third principle of insurance is utmost good faith. So the insured must be truthful concerning the information pertaining to the policy contract. The insured must have proximate cause. So whatever damage is caused must be close or proximate to the event insured against. So, for example, if you have an accident policy that includes death occurring as a result of an accident, This person will not be compensated if death is caused by disease. So let's think of an example. You are a driver and you insure your car, you have an accident policy on your car, right? So if death occurs, you would receive, because of the accident, you would receive some money, right? Now you pick up somebody who is sick and you're transporting them to the hospital. Now, on the way to the hospital, the person dies and you panic and you get into an accident. You cannot go to the insurance company and claim anything from them because your insurance policy says that you're going to get money in the event that you get into an accident and someone dies. But remember that the person died before the accident. The person died, and as a result of that, you panicked and got into the accident. So therefore, the proximate cause principle would say that you would not be able to receive money for that incident. All right. The fifth principle of insurance is contribution. And this principle prevents person insuring identical risks on the same property with several companies and thus profiting if they suffer loss. So, for example, an individual may insure his car with three insurance companies, hoping to be compensated by all three. However, he will realize that he will not be successful because what they will do now is to put together their portion of the claim. So let's say that the car is worth $150,000, right? And there's three companies. What they will do is to divide that car by three, and each party will now give $50,000. So it doesn't make sense that you insure one vehicle three times, right? You won't profit off of it. Continuing with principles of insurance, we have average clause. And this clause sets a limit to the size of compensation, which will depend on the proportion of the true value of the asset paid up by the insured. So, for example, if you insure your home for $100,000, but your house is worth $200,000, right? You will not receive full compensation if your house is damaged. You only insured half of the house because $100,000 would be half of $200,000. So whatever happens to your house, you only receive half of the value. So a homeowner insures his home for $100,000, which is half the true value of $200,000. His house was partially destroyed by the fire, and the insurance company for $50,000 worth of damage, right? The insurance company only paid him $25,000, which is 50% of $50,000. All right, so they will only give you how much you choose to insure. Subrogation. Subrogation is an extension of the principle of indemnity. The insured should only be reinstated to its exact position before the loss. So, for example, if a vehicle is totally wrecked and the insurance company pays the insured the value of the car, the insurance company have to keep the wreckage because guess what? They know that if they allow you to keep the wreckage, you can always go and sell it. So if they give you the full cost of the car, they will have to keep the wreckage because they don't want you to go and sell the car and end up with more money than that which you lost. All right. So insurance will never try to allow for you to have more money than that which you lost. How does insurance work? So let us speak about how insurance works. It works by pooling together, right? Pooling together sums. How are insurance companies able to pay its clients large sums of money to compensate them for loss? They operate on a basis of risk pooling. Premiums from a large number of persons with the same risk are pooled, only those who suffer loss are compensated. Now, the insurance company, they predict the percentage of losses based on past data. The premiums charged would be based on the number of losses that they predict, plus the cost to operate the business and profits to be realized. For example, a particular insurance company may insure 1,000 persons for risk against car theft, but only 2% of that insured may actually suffer that loss. Do you see? They are making a profit. And I want you to think of an example in your classroom. So sometimes your teacher might collect dues. Let's say you're paying $100 for dues every week. Now, remember that there might be 40 students in your class. So in all, the teacher might be collecting $4,000 for dues from the 40 students. Now, the teacher might say, I'm collecting dues to buy lunch for anybody who loses their lunch money. Now, in a week, maybe only two persons lose their lunch money, and $500 would be the cost for lunch. So, therefore, only $1,000 would be spent on lunch weekly. So that's how insurance works. You would be profiting. So maybe at the end of the year now, the teacher will say, okay, I'm going to keep a class price because she will realize that she has a lot of money left over. So that's how insurance works. So let's look at this. This is a group of persons, eight of them pooling together, right? Now, what you will notice is that only two persons, which is client one and client six, suffered a loss. So you see where they are getting back money out of the pool of funds. So eight of them are putting in money on a monthly basis, and only two of them suffered a loss. So it works out. All right, that's how insurance works. Let us talk about the types of insurance policies. So we said that if you have a life insurance, it is actually a life assurance. And there are two types of life assurance. We have the whole life assurance, which is payment will be made upon the death of the insured. So only the beneficiaries of the insured will be paid. While we have endowed assurance, where payments are made at the end of specific periods. So what the endowment policy says is that it may be paid at the end of 20 or 30 years or at the age of retirement. If death occurs before the endowment period, then the beneficiaries will still receive the insured money. All right, let's talk about some other terms and business insurance. We have fire insurance, which covers the losses or damage to assets by fire. We have burglary insurance, which covers the loss due to goods stolen and damages to property caused by theft. We have bad debts insurance, which covers debts that cannot be collected. We have plate glass insurance, which covers the replacement of shop windows as well as any injury to staff and customers that may be caused by this breakage. We have fidelity guarantee insurance, and this protects our firm against loss due to the misappropriation of funds by employee, customers, or other persons. Now, this one we might be familiar with employer's liability insurance and public liability, which covers injury incurred by staff or visitors on a business location due to the negligence of a firm. So, usually, when you go into a firm and they're wiping, you will normally see a yellow sign that says, watch your step, and something like that because the floor is wet. Now, if they don't have that and you slip and drop on a wet floor, the employer's liability insurance will have to cover it because you can, of course, fine the company if they don't have insurance. All right. But if there's a sign and you fall, then they won't have to go for an insurance claim because there's a sign and you should have read the sign before you went on the slip before. All right. We also have motor insurance, and there are two types. You have third party insurance where only the passengers are covered. So if anything happens, the driver and the car will not be covered, only third parties. While you also have comprehensive motor insurance where it covers a loss due to the damages to the driver and any third party. We also have marine insurance, which is the policy. That policy covers loss due to the damages of ships and cargo at sea. And lastly, we want to look at how is insurance important to business. Entrepreneurs, they invest a lot of resources into the startup and continuous operation of the business. So if the entrepreneur suffers any loss, such as fire or burglary, the business may take a long time to recover. That is why insurance is important because remember that the principle of indemnity ensures that the entrepreneur receives enough compensation to continue the business with minimum effects because insurance will put back that person or that entrepreneur in the position that they were before they suffered any loss. Now, it encourages enterprise or industry by covering risks or business firms. Sorry. It facilitates trade between countries whereby businesses will be compensated for losses during transit. So when you're sending your packages to other countries, you have insurance covering them. So if they are lost, then you will receive compensation. It also provides a source of capital for business investors and provides coverage against personal risk when an individual is not able to manage it. All right. So if you have any questions, just comment below and I will answer them for you. Thank you for watching. Bye.